Hi, this is Dustin with Dustin's Dollars. Today, I'm going to be talking about NextDecade, going over some recent updates to the company and a small updated simplified valuation model they have for the company. Um, Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in NextDecade, so this video should be for your entertainment purposes only because I could be wrong about everything I say in this video, and you need to do your own research before making any investment decisions. All right, so real quick before I begin, sorry for the huge long delay. If you follow me on Twitter, you saw I posted this a month or two ago. We adopted a toddler that is actually our fourth child, so I've been pretty busy, forgot what it's like to have a toddler, and so I really just haven't had the time to stream. And I appreciate all the folks who left me comments asking where I was, and I am back. I can't promise any particular frequency, but I am going to try to stream as often as I can. My target is weekly, but we'll see what happens. No promises. And I appreciate everybody who still watches my channel. Anyways, getting on to it, I also want to say I do have a new streaming setup. So if there seem to be any issues with this video, please let me know in the comments, because again, you never really know if there's issues when you get everything set up until you go live. So please let me know if there are issues. Hi, Ray. Thanks for hopping on the stream. Thank you for the congratulations on the adoption. So anyways, getting on to the business of today, I'm going to be talking about NextDecade and going over just some of the updates and my, sort of newer updated valuation model. So real quick overview, if you are not familiar with this company, this is NextDecade. They are building a liquefied natural gas export facility I believe they're in Texas. It's a Rio Grande LNG is the name of the facility, and you can see this sort of mock-up right here. Doesn't look like that yet. That's what they want it to look like, right? That's the artist render, and you can see it there. They've got all that. It's all the liquefaction facility there, and they're loading the LNG right there onto a vessel that they can go ship it off. And hopefully you're already familiar, but that's, the company ticker is NEXT. You can go look that up and see all those details. But I'm going to go into some of the details of the company because I follow this on my channel for a while. So I'm going to largely use their investment presentation and some of their press releases. And so this was a big one. If you follow my channel and follow this company, there was back in 2024, maybe even 2023, sorry, it's been a while. There was some regulation issues with Rio Grande facility after it reached its final investment decision, after they started construction. The federal government kind of had some issues with exactly some of that. There's a thing with a supplemental environmental study that they needed to do, basically. And as far as I understand it now, that's more or less done. There was this press release in March, and they said, hey, they removed the vacatur risk, meaning that they could consider or continue on construction. That's my understanding of it. And then they also put this in their first quarter update, where they said, yeah, and the FERC issued the draft supplemental environmental statement, and they're going to they expect them to issue the final supplemental environmental impact statement in July, right? So that would be this month now. Again, this press release was from March, I believe. And so we have yet to see that, but I expect it to happen with the current administration, right, and the current FERC agency, that should just happen. And so this risk should basically be gone. And of course, that's why you've seen the stock go back from the, I don't know, fours up to the, $8 to $7, $8, and even now $9 range. Now that risk is basically gone. So moving along to the actual trains 1 through 3, I'm going to go through this deck. I'm just going to pop around to where it makes sense. They give these updates every quarter, and they say, hey, we're still on track for construction. And again, Bechtel is constructing this for them. It's not actually the NextDecade company itself. They have that contract with Bechtel, and Bechtel is making good progress. Ostensibly, that's what they've reported quarter after quarter. And we do trust Bechtel, or at least I do, and that's based on history. And so seems like that's going well, and that's excellent, right? And they still have their target completion dates in this investor deck, and I do not believe these have changed from train 1 ending in the end of 2027, train 2 in mid 2028, and then train 3, let's say end of 2028, beginning 2029, somewhere in there. And that's fantastic, right, that they stay on schedule, because now we are halfway through 2025. When I did this valuation model for NextDecade at the FID point, we've progressed quite a bit of time since then. So that valuation just for the first 3 trains is, higher at the current moment because of, all that time that has passed. We are closer and closer to finally seeing some cash flows from those. Again, we're still years away, but we're, much closer than it was at FID, which is pretty fantastic. So moving on to that, I don't really have much more to say for trains 1 through 3, right? We just got to let them build it. And now we can move on to train 4, and they have made significant progress there, right? They have enough sales and purchase agreements to actually support the financing for train 4. And they had it here with ADNOC, that 1.9 million tons per year of LNG, and a deal also with Aramco for 1.2. And then Total, as we expected, exercised their option to purchase 1.5 million tons per year of LNG from train 4. And I think Total, this is getting a bit ahead of myself, but they also have that option on train 5 of the Rio Grande facility for that 1.5 million tons per year. And that's a good partner for a NextDecade and good tailwind for them for the train 5 progress. But just speaking on train 4, right, they have enough sales and purchase agreements in place to actually get the banks to loan them money to continue on and actually execute a contract with Bechtel to get them to start construction on train 4. And they did have this update. Let me close these. They did this update recently where they locked in their EPC pricing for trains 4. And this happened, 3 or 4 weeks ago, I guess, on June 12th. And they said, hey, we locked it in. The price is going to be $4.77 billion for the work for train 4. And this pricing is valid through the end of September 15th. And so that gives you your time frame that the company is certainly targeting to happen to get their FID within that time frame. And so if you're trying to model things out, I think that's what you should be looking at there. And that, if you go back here, if they are able to get FID by the end of 2025, and you look at these, let me go back to that. These timelines, if you sort of cheat and you say, oh, what's a timeline that they have for these? These were about, 4-year timelines. And there were also some common facilities that they built here, although you have to imagine a lot of that was parallelized with the actual LNG train itself. But I think you could expect 3 to 4 years to build that additional train at the site. And that is, if they get that in 2025, that gets a start date of maybe, 2029, maybe end of 2029, let's say, for train 4, if they can get everything in place by the end of, or middle of September, right? On that time frame that they actually are, have the pricing locked in from Bechtel. And so I think that's pretty good at the current moment. That's kind of what I expected when I did some of my models, in prior years and prior videos. So that's fantastic. We're just waiting to see what they can get put together with the banks. The other big piece here that I will call out, and I think as soon as they announced that last that last deal that got them up to that 4.6 million tons per year that they have contracted for train 4. When they announced that deal, I think my tweet at the time was, cool, train 4 is going to happen, right? They've got the sales and purchase agreement, so the rest of it, are just dominoes. They're going to fall after that point. But the question is, how is NextDecade going to fund their portion of the equity for that train, right? Because I think I don't have a slide here to look at, but maybe this is the one, right? So they have in train 4 for the equities. I think these other partners have options to participate in the equity for these. And so there's kind of this framework in place. Maybe it's this slide. No, this is all talking about, phase 1. But this is the one really where they're saying, hey, they have options in place that might accelerate the FID timeline for trains 4 and 5. And this is they have the partners who invested in, phase 1, trains 1 through 3, also have this framework to set up to invest for the equity portion of trains 4 and train 5. But NextDecade also has to pony up some money for their portion. And so the question is, how are they going to get that money? Their default answer here, unless they can do something creative, is just they're going to issue stock. Probably, if I look at history, they've done some private placement deals here where they just sold a whole bunch of stock in one big block to somebody, and that is the big question: at what price are they going to dilute, and how much are they going to have to dilute exactly? I think my general, if I understand the financing here correctly, they are intending to put forth 40% of the equity portion of Train 4, right? And so if you do a rough split, 60% debt, 40% equity, and NextDecade is putting in 40% of that equity, so it's 40% of 40%, then you're looking at 16% of the overall cost of the EPC contract for Train 4, right? And so that would be, if you're just going off these numbers, 4.77 billion. Let me pull up the calculator. Hopefully that, I don't know if you can see this or not, 4.77 billion times 0.16. That gets us to $763 million. And I do have that modeled out in my evaluation model, which I'll go through in just a little bit. But again, that's a lot of money for them to come up with. And so, if they did $763 million at a share price, they usually issue at a either discount or, sort of volume weighted average price over prior trading days. And funnily enough, when they do these deals in the past, and I've seen this not only on NextDecade but on other companies, when they tend to do these stock sale private placement deals, stock tends to fall during that pricing time. I'm not saying that there's some shady stuff going on, but it certainly seems that way. The stocks do trade downwards during those pricing periods. It could be coincidence, but maybe not. But if they were to do that at, hypothetically, if they did that $8 per share, which again would be a discount to the current trading price, that would be about 95 million shares issued in order for NextDecade to get their to come up with the cash that they need for their portion of the equity for Train 4. And so that's still a big outstanding question mark that they have not, to my knowledge, have not given any guidance on. So that's definitely something to watch out for. And the stock tends to react pretty strongly, or not. I'm not talking about NextDecade in particular, but in general, lots of stocks tend to react sharply, lots of time to the downside when those sorts of agreements are announced, right? If they say, hey, we just sold a whole bunch of stock, people view that dilution negatively a lot of times. So that's just something to watch out for. Anyway, so that's kind of where Train 4 is at, and kind of what I'm watching out for that. But one really cool and interesting thing was recently they announced this sales and purchase agreement for some of the LNG that could come from Train 5. And so that's really nice to see where they're even looking beyond Train 4. They have 2 million tons per year, which is a pretty large deal in terms of how much they need, right? I think the target would be about 4.5 million tons per year to get contracted for Train 5 to be supported commercially, where they can actually get the project financing in place, because that's about 75%, somewhere in that vicinity, 75% of the volumes being contracted. And so that's pretty cool when you view this 2 million tons per year. That's almost half of what they need. And then when you look back at the options that Total has, and I think I don't know where it's at, but Total has these SP options in Train 5. It's about a 33%, right? Because they have this 1.5 million tons per year. I think it's down in the it's down in the footnotes. You probably can't read it here. I'm highlighting it. Total Energies holds an LNG purchase option for 1.5 MTPA in Trains 5 on a 20-year basis. The actual terms of the deal are down there, or the indexing terms. But Total exercises for Train 4. I expect them to also do it for Train 5, especially considering Total holds, a bunch of NextDecade, the ownership in NextDecade itself. So why wouldn't they? They're kind of get the double dip there, and they got sort of, share in their own upside for doing that purchase. And so really, if you combine this 2 million tons per year that they've contracted with JERA, and then 1.5 that we expect Total to do, they really only need another 1 MTPA to get contracted to get to that 4.5 MTPA threshold, where they could probably get all the financing in place and then get an FID on Train 5. Which brings me back to the this announcement here, where they locked in their contract pricing for Train 4. They also did it for Train 5 at the same time, right? And so they have the same exact timeline for the pricing validity under Train 5 here, right? The pricing validity on Train 5 EPC contract extends through September 15th, 2025. And so, they basically imply, or maybe they even state it here, where they're, where does it say? They're working on commercializing additional, 2.5 MTPA under long-term SPAs to support a positive FID on Train 5, and they're targeting FID before the end of the pricing validity period for the Train 5 EPC contract. So that would be pretty cool if they get both Train 4 and Train 5 to an FID by the end of, or by the middle of September. That's a pretty aggressive timeline, I think, for Train 5. I think it's almost a shoo-in for Train 4 unless there's some major surprise. But Train 5 would be aggressive, but I mean, that would be great to see as a shareholder. Again, one of the questions there, I have the same question for Train 4 or for Train 5 as I have for Train 4, and that is, how are they going to come up with the cash in order to fund their equity portion? But maybe if they are doing both of these at the same time, they could raise all of that money simultaneously, for Train 4 and Train 5, kind of as one transaction, and that, maybe they can get better terms, because if they've already got everything else in place, they can show quite a bit of future cash flows that are going to be locked in. One thing, once again, that I will also call out for Trains 4 and Trains 5, they have these announcements, but they do not announce the pricing to us. To say, it's indexed to Henry Hub, but they don't say what the actual fixed fee is that they're getting. I think for Trains 1 through 3, they got an average of $2.5 per MMBTU, and I think we can expect them to have about the same, or maybe a little higher, maybe 260, 270. That would be really fantastic if they could, any higher that fee goes is just pure upside for them. I think they can be profitable at 2.5, especially on Trains 4 and 5, which are expansions. So the actual the capex for those is going to be a little bit lower, and that, because of that, then the interest expense is a little lower, and so that's all going to be give them better unit economics on Trains 4 and Trains 5, which I've talked about in the past. Anyway, so hopefully that gives you a pretty good overview of where Trains 4 and Trains 5 are at. They did also talk about further expansions, and so they have some. I'm going to go to this slide right here, and they have this image. They talked about Train 6, and then they said, hey, we have space for all the way through 10 trains. They're already starting the permitting process for Train 6, and I don't know if many people know this. I've been following this company for quite a while. This site, as you can kind of tell here, this site was originally designed for 6 trains, and then if I recall correctly, basically what happened was they said, oh, we really think we can actually get more throughput, more LNG to be exported from Trains 1 through 5. And because of that, we can, based on what their original FERC filings were and their original volume of LNG that they filed to be able to produce here and to export from the Rio Grande facility, they were able to actually produce that volume of LNG only from the first 5 trains. They didn't even need to build Train 6. This happened in, 2019, 2020, somewhere in that vicinity, when they were doing the original filings and design for the site. So it's been years since this point. But as you can see here, the site was actually designed for 6 trains. They're going to be able to plop this 6th train right in here. I think their costs for Train 6 are going to be much closer to the economics that they have for like Train 4, Train 5, where these are able to share a lot of these common facilities, the roadways and some of this, internal piping that they have at the actual site. And I think these trains 7, 8, 9, and 10 that are kind of outside of the existing developed site are still within their control to do, but the unit economics are probably going to look more like Trains 1 through 3 in terms of the capex that they have for those. And so it gets a little bit interesting when you go ahead and model those out into the future, but that's just something to keep in mind as you're looking at. So I think the unit economics on Train 6 are going to be great. Trains 7 through 10, not quite as good as we have for Trains 4, 5, and 6 in isolation. But that is really good to see, because they weren't very, this was kind of a newer announcement that's actually came from the company. I sort of always expected they're going to have future developments, that they weren't just going to stop at Trains 1 through 5, Rio Grande LNG, and let this be a cash cow forever. They were going to expand past that. The LNG market is, I think, still pretty hot. But, oh, Matt Money, holy crap, I did not realize you were on here. 20 billion market cap in 10 years. Thanks for hopping on the stream. That's surprising. You're one of my favorite guys to watch on YouTube. Most contracts into Henry Hub had 115%. Yep. 2720 MTPA, the 45 MTPA, 8 train capacity, Rio Grande will be equity owned by NextDecade. Okay, so that's that's about right. So I think let me go to my valuation model, because I think I've talked through everything here. Well, I will give one mention. Sorry, Matt, I don't know if you're still there. That's awesome to have you on here. Thanks for joining. If anybody else on here is not familiar with Matt Money, he's great. He's got lots of Cash Flow Chronicles is a great watch, although I think they just pause. And Matt Mundy has his own streams. One of my favorite YouTubers, possibly my favorite YouTuber, on there. They're just fantastic view. Anyways, the company does give these projected numbers for their cash flows. They don't give a whole lot of detail for the underlying numbers they go into here, and so I'm going to go into my own model that I have. But my numbers roughly line up with these. They're actually a little bit, ever so slightly lower from these. But getting back to what, I'll just go to mine here after I mention these. So they say $203 million per year for trains 1 through 5 in terms of cash flows that they can actually distribute to the NextDecade common stockholders. Not necessarily that they will distribute it, but that they could. And then trains 4 and 5 are much higher on a per train basis, right? So they say $700 million to $1 billion for the combined trains 4 and 5. And yeah, so Matt's given the details right here. 20% of trains 1 through 3 is owned by NextDecade, and then 60% of trains 4 through 5. The company noted they want to maintain 100% of trains 6 through 8. So that's really interesting, right? I'll go to my model, right? And so I have the value for trains 1 through 3, and I have similar those numbers. I think I put in here, it's really the rounding error to the 0.8%. But yes, it's 20% for trains 1 through 3, 60% for trains 4. Hopefully you can see these. I could zoom in even a little bit more if I need to. Maybe that's a little bit better. So real quick, the structure of this model that I have basically each column here is, one of the phases called just trains 1 through 3, phase 1, and then 4, 5, 6. And then I just glom together trains 7 through 10 just as one glob, because we really don't have any details on those. I kind of just made up, I'm not going to say made up some numbers, copy pasted, and then have just some rough numbers for those. I think it's much more concrete for trains 1 through 5, and then train 6 I expect to be pretty similar to train 5, as I mentioned. But yeah, what Matt is talking about here is the actual percentage that NextDecade is going to own of certain phases of the project, right? And so for the trains 1 through 3, they just really didn't have any cash, and so they had to dilute 100. Every dollar they put in for equity, they had to just dilute their stock, and so they were really reliant on other folks because there's a limit to how much they can actually dilute at that point. So they own about 20% of trains 1 through 3. But trains 4 and 5, as long as the final cash flows end up meeting thresholds that they don't actually specify, but I think are pretty reasonable. Hopefully the company has done a good job, and I think they've gotten my trust in the past, right? This company has actually executed where some others haven't, and I think they've steadily just been building. And so whatever thresholds they have that they need to meet, I expect they are going to actually meet those thresholds. So I think their ownership of trains 4 and 5, or the cash flow benefit to them, let's say, is going to jump up to the 60% threshold, where, if I understand correctly, they only have to put in 40% of the equity. And so that's why a little bit further down I have how much money they're going to have to raise for the equity portion. And so you'll see that's only 40%, even though their ownership and the benefit to the NextDecade common equity holder, meaning us, if you own the NextDecade stock, is going to be 60% of trains 4 and train 5. And so I talked real quick about what the company was projecting for their numbers. I see Matt says, love this model, man. Great work. Thank you, Matt. Well, Kaza, thanks for hopping on the stream. Really appreciate having all y'all here. And so I modeled this out real quick. I'll go through this and I'll be as brief as I can. I have how much LNG they actually contracted for each of these trains. I assume they're going to contract 4.6 for each of trains 4 through 6, and then they have 16.15 contracted for trains 1 through 3. That actually leaves some volumes that they can produce uncontracted. For trains 1 through 3, it's a small portion, right? It's only 1.4, so they're like 90% contracted for trains 1 through 3. Trains 4, 5, and 6, I expect to be about 75% to 80% contracted. That leaves them a little bit more on a percentage basis on contract. And I expect they're going to sell that at spot or under short-term agreements that are going to get much higher fees. And right now I just put in $4 per MMBTU. You might expect that to be higher. I guess potentially also low, but I think $4 is at least conservative. I think they model in a little bit additional margin over Henry Hub, right? I think they can skim a little bit off of that 15%. I know that some of that 15% over just the purchase price is meant to cover the transportation cost, but I think they can skim a little bit. That's my hope. So anyways, I multiply that out and get the actual net revenue. Then I modeled out what is the debt that they're going to have to take on for each of these trains, and I assumed I think like I use the actual debt for trains 1 through 3, and then I assumed about 60% of the cost for trains 4, 5, and 6 were going to be debt, and so then I looked at what's their interest expense. I just put a flat 7% rate on that debt to get their actual interest cost. Then I also put in some numbers for operating costs. I think I just assumed 80 cents per MMBTU across the board. And if I recall correctly, I think I got these numbers from Cheniere from 1 quarter or a year or something. And so I think that's a pretty reasonable estimate. From that's how I calculate the free cash flow to the Rio Grande LNG. And then again, we multiply by how much equity percent does NextDecade actually hold. And that gets us to the free cash flow to the NextDecade, to that actual company, right? The equity that we hold. So these are the numbers that roughly correspond to what the company had. If we go back, they're saying $200 million to $300 million per year for trains 1 through 3. My model actually comes out to $187 million per year. So I think that's in line. Again, you might expect them to be higher. There's a whole number of assumptions in here that maybe I'm too bearish on, but that's kind of what I have. And then goes up to about 300 for trains 4 and 5, which again is undershooting what they are projecting here. These numbers really haven't changed, if I recall, for 3 years in their investor presentation. So maybe they're right, maybe they're off a little bit. I also am a little bit skeptical of management over time. You just look at enough companies. They do a pretty decent job, but they tend to give you a fairly optimistic picture. And I'd also rather be conservative in my own modeling. So again, that's kind of my bias here, but that's what my model comes out with the assumptions that I put in here. So now I know that's a lot, but that's kind of the fundamental basis here so that we can now talk about valuation. And I've done a couple different models here over the years, or a couple different ways to say, okay, now if I look at their free cash flow per year, how do I then model that out to get to a present value? And it dawned on me that I should just model this really as a perpetuity. So this is a concept. If you have like preferred stock, sometimes it'll say, hey, my preferred stock is going to pay out $10 per year, literally forever, right? It's a perpetuity. So until the company buys back or extinguishes that preferred stock, it's just going to pay this forever and ever and ever. So it's like a bond, except it never expires. And so there's a way to value that. It's actually very simple. Just divide that by the your discount rate that you want to put on that, and then that's sort of the present value of that perpetuity. And so I use just an 8% discount rate here for those cash flows. And because if you look at this, they're going to pay it out every year, hopefully for 30, 40, 50, 60 years, right? I mean, I think the initial contracts, the sales and purchase agreements, are for 20 years, but this infrastructure is not going to go away after 20 years. It's going to stick around, and as long as they keep operating this, and people still need LNG, there's no reason to expect that they wouldn't be able to renew those contracts or sell it to a different party. And who knows what fees are really going to get after 20 years, but I kind of just model this as a perpetuity because our current best estimate is that they're going to be kind of like the pricing that they have with the existing contracts. And again, this is use an discount rate here, even though the cash flows obviously are going to be higher 10 years and 20 years down the line because there are price escalations, but you just use that discount right here to discount all those future cash flows back to today. And so that gets you to the current value of that perpetuity. And so I have this for trains 1 through 3, train 4, train 5, and 2. You can see for trains 1 through 3 combined, really the net present value for that, if you value as perpetuity, is about $2.3 billion. Train 4 just by itself is worth more than trains 1 through 3 combined because, again, the NextDecade ownership is much higher. It's 3 times as high. It's 60% versus 20%. And the CapEx on those is even slightly lower, right? Because they don't have the cost of all the common facilities that are being built for trains 1 through 3. And so that gets you a much higher value for train 4 and train 5. And that's where really a lot of the value comes in. And then I assume train 6 is going to be very similar to train 5. In fact, I just copy pasted that other than just putting the starting year out another year. And so that's kind of how I look at it. I also then discount that perpetuity using the same discount rate back to today because the perpetuity would have that value when the cash flows start. And so trains 1 through 3 are going to start their cash flows in 2029, train 4 in 2030, train 5 in 2031, those are my projections, and so on. So you have later years for train 6 and then 7 through 10. So you'd have to discount the value of that perpetuity even back to today because the cash flows haven't yet started. And that's where you come down to it and you say, actually, trains 1 through 3 as a portion of the current value of the company are still close to on par with train 4 and train 5 because you're discounting that over a lot less years. And so the sooner cash flows are worth more to you. Anyways, when we look at the actual dilution that they're going to have to do, right? That's sort of the next section here. That's, as I mentioned, a big question mark in terms of how is the company going to fund their portion of the project for trains 4, train 5, train 6, and then also for trains 1 through 3. They have to continue funding their company until the cash flows start. And so I did this estimate of how much money I think they're going to have to raise. I think I looked at I didn't look at it today, sorry, because I put a lot of this model together a couple weeks ago. But I looked at what were their quarterly costs and kind of multiplied it out over the next couple of years because they're not going to have any positive cash flows until at least that first train starts, and maybe train 2, train 3, right? We're not sure exactly when they're going to hit that break-even point for the company, but they've got a couple years ahead where they just have to fund the company, probably through diluting the equity, right? Through that, likely through an at-the-money offering, or if they do a big block of private placement shares, that could be done. Anyways, I assumed for trains 1 through 3, they're going to need about $675 million to fund the company between now and when they finally hit operations on all 3 trains. I assumed for that dilution, I assume the share price of $8 per share, again, because we don't really know what that's going to be. Hopefully that's conservative, given that I think last time I checked it was trading around $9. So that would mean about an additional 84 million shares being issued just to fund the company until train 3 is operational and they can actually fund the company from their own cash flows. Similarly, for train 4 and train 5, they're going to have to raise money just for their portion of the equity. And I went through the math here to get to about $700 something million they're going to need for train 4, about $700 million for train 5 because that one's slightly cheaper than train 4. For now, I'm just looking at, again, to be conservative in my modeling, $8 per share for dilution for their portion of the equity there. And so if you look at that, that comes out to 97 million new shares for train 4 for their equity portion, 87 million shares for train 5. And so if you look at all of that, by the time we get to train 5 issued and they funded the company for trains, until trains 1 through 3 operational, they're going to have about, this is my projection, 530 million shares outstanding. That's my estimate of their future share count, at the point that they've got all the cash in place for everything through to, funding train 5. And that is sort of the denominator, right, for all of my valuation. So now I can add up that value of each of these trains, and then I can divide by how many shares are going to be outstanding if they get train 4 FID and train 5 FID, and then actually raise that money, right, to actually dilute the stock to raise that money to fund that portion of the project. So sorry, no, I'm finally getting the conclusion here. If you look at that, then I can add up what is the current present value of all of those future trains. And so this column here is just looking at trains 1 through 3. And so again, I don't mean this number is going to look low. There are reasons for that, right? Because this is just what the model is assuming. But that is, present value, I would say, is about $5 per share if we thought they're going to only ever do trains 1 through 3 and nothing else, right? And clearly the stock is valuing much more than this. But I think that's really where the fair value would be if you were super skeptical on trains 4, 5, and 6 and anything beyond. I'm very much not skeptical, so I think it's, and this is what I think the market is pricing in. If you add in the value of train 4 and assume they only dilute for train 4 and don't do the further dilution for trains 5 or anything else, you do get the sort of a total present value once you add on train 4 of a tad over $4 billion. Divide by the assumed future share count of about 440 million shares, and that gets you to a present value per share if you assume train 4 is already FID and there's really no risk on that front, of about $9.25. And that kind of tracks with where the stock is trading. Now, if you also include train 5 in that, if you say, hey, I'm very confident train 5 is going to happen, and personally it does seem like train 5 is, seems like it's going to happen. They've got significant progress here, and they even got the EPC contract locked in, and they're trying to meet that timeline, which, again, I will say, if you haven't been in stock for a while, they, in 2018, 2019, 2020, they always said, here's our timeline, and then they blew past that timeline. So you do have to take it with a grain of salt, but I think the company, I will also play devil's advocate to myself there and say the company is in a massively different spot today than they were back in 2018, 2019, 2020, because, they have trains 1 through 3 FID. They are building it, and so they know that they're going to have some free cash flow in the future coming in. They've sort of got this much stronger negotiating position, and I think the economics on train 4 and train 5, again, because those being better, do let them make these deals without needing to be, without having to be worried that they're not necessarily going to be making their profit targets on those. Anyways, long-winded way of saying I actually I'm pretty optimistic on train 5 at the very least, if not also train 6 in the future. But if you include train 5 and you say I think there's very little risk, I'm willing to give it only an 8% discount rate right now, which is basically just what you'd give it if the risk was fairly low. I think that gets you to a present value per share for the company valuation of about $12. I also did include down here, if I wasn't discounting these things back to today, and I said, what's the value going to be at the year that these phases hit full operations? And so you can see that row down here. I'm not going to talk too much about that, but you can see sort of that's the appreciation you expect to see. Like if hypothetically, let's say the FID trains, trains 4 and trains 5, and they meet all the assumptions that I said for dilution, etc. Present value to be about $12 per share. But then if you just sit and hold on your shares, because over time those cash flows get closer and closer and closer, by 2031 it would appreciate about 50% up to almost $18 per share, or at least my valuation of the company would go up to about $18 per share, just because the time is passing and those cash flows are sooner, right? Now I can go on and look at train 6. If you look at that adds on about another $2 per share in present value. If you really think that's going to happen and you're willing to value it, with super high confidence using similar numbers as train 5, which I think is reasonable. And, so that's obviously quite a bit of appreciation over the current trading value of the stock. And then trains 7 through 10 are a lot harder. And I'm going to go through some of the assumptions here because they don't add on that much for 2 reasons, right? Number one, because the cash flows for those are so far into the future. I think I sort of put on a starting year for all 4 trains because I just modeled them as one block here of maybe 2035. It's really hard to say, like, that's a lot more capacity for them to contract out, right? I think they'd have to contract out, if they're going about 75%, I think I multiplied out, it's about 18.4 million tons per year that they'd be contracting out, leaving 5 uncontracted. And then I also think the unit economics are going to be much closer to trains 1 through 3 rather than trains 4, 5, or 6, because, as that photo I showed before, those are sitting outside of the common areas of the current site that they've developed. So they're going to have to do more kind of infrastructural work, leveling the ground and other stuff that I am not in the industry, so I don't know in enough detail. But I think that's it's reasonable to expect the unit economics are going to be worse for trains 7 through 10 than they are for 4, 5, and 6, because 4, 5, and 6 are bolt-ons to the existing developed site area that they have. Anyway, so you have that, and then you also, as I mentioned, because of that, the equity portion is pretty high, and also the starting year for the cash flows is pretty far out. I model as 2035, and so that discounts it quite a bit, and so the present value doesn't add all that much, even though it's an entire 4 more trains. Now, the interesting thing, and I'm going to go back. Sorry, I don't know if Matt is even still here. He mentioned the company has noted they want to maintain 100% of trains 6 through 8. I modeled this right here as if they own 60%. But the interesting bit here, if they do want to own 100%, is how they would fund that. And I don't have that in here. But I'm gonna hand wave here and say, hypothetically, what if I just change this to 100% equity for trains 7 through 10? The cash flows obviously increase quite a bit. Their equity portion goes up quite a bit, but I'm gonna wave my hand again. Let's say they did not actually have to dilute. Let's say they were able to use their free cash flow at that point to leverage and say, hey, we're going to take on some debt. That debt's going to be a much smaller, overall cost to the company. And so if I change this dilution here, hypothetically just to 0, now, the new shares that would be issued for that. Sorry, now I'm jumping back and forth. A little hard to do this live. No new shares. Now the present value for that jumps up, $14 per share at current price, and the future value is, adds quite a bit. And so if I were to do that, what was that, about 4? Let me check that real quick. So that was, I was assuming they were going to need $4.3 billion. So let's say instead for this debt portion, right? So if they are actually owning 100% of the equity, if I just add this on to their debt, let's say I add on, let's say just round this up to $21 billion of debt. If they were able to do that, so they're, it's because this is actually modeling out what is their additional interest expense, right? And so I have this line here. This does actually even incorporate this interest expense. So their cash flows are lower than it was before, but they are owning 100% of what they get after that from trains 7 through 10. If they did that, the net present value per share, the increment from train 6 to train 7 through 10, this is even assuming that you don't get any cash flows from it until 2035, would be about, it's almost a doubling of the shares. It goes from, trains 1 through 6 worth $14 per share, trains 7 through 10 worth about $26 per share. And then once they hit that full operations, that would get you closer to $50 per share. And I have it modeled here as $47 per share with those assumptions. But that, if they really do own 100% of that equity in trains 7 through 10, that could be humongous for the company. Again, there's a lot of question marks, a lot of steps that have to happen between here and there, but the potential is there, right? This is not a full, it's not as deep as a model as I would want to go in before I really am confident, put my name 100% behind, yes, $47 per share at full operations 2035, because I actually don't know. You don't have to think through and model out how realistic is it for them to own 100% of the equity, but these guys know more than me. These guys are looking at the market. They're looking at, both the LNG market and the financing side. And, if they think that they can, obviously they want to maintain 100% of trains 6 through 8. I guess that's 6 through 8. I modeled actually 7 through 10. So I didn't quite take your, what you said, Matt, at exactly what you said. Sorry, I misread. I was just kind of applying it to 7 through 10, trains 7 through 10. But I think that the principle still applies, where if they are able to do this and not have to dilute in order to actually get that, maintain that ownership in trains 7 through 10, or train 6 even, that could be really huge for the stock. So hopefully that makes sense, everybody. That's kind of everything that I had through today. It looks like there are actually quite a few people on here. Trying to watch the chat both on my phone and in the OBS studio. It doesn't always come through so well. So I will stick on for a little bit in case anybody has questions or comments. Thank you everybody for hopping on. Sorry I was gone for so long. I will try to stream a little bit more. Hi Transient Stacker. Thanks for hopping on the stream. Yeah, and Matt says, awesome spreadsheet, brother. Absolutely. I can share. I will make a copy and share this, put the link in the description after this video. Sorry I didn't do it up front. I probably should have. Folks, yeah, inevitably I get somebody who asks for that. I'll do it probably 5 minutes after I hop off of this stream. Yeah. Can you MSTR? I can talk about MSTR quite a bit. Do you have a specific question on MSTR? And sorry, for anybody who's watching for NextDecade, I'm happy to answer questions, comments on that, but that's all the prepared material that I have. So my most recent videos that I did before taking a break, I did actually do MSTR. I don't think a whole lot has changed on them. They have actually issued more. So my last video that I did on MSTR did talk about kind of how much Bitcoin per share do I think they can actually accumulate, right? And I put together a model there because a lot of people, it's how I try to model the company, right? I think a lot of that comes down to, I'll give you the cliff notes here. You can go watch it, or if you've already watched and have questions, I'm happy to answer them live here, but the general concept for MSTR, right, is they're a Bitcoin treasury company. They also have their software company that is doing business intelligence and does generate some free cash flow. But their primary operation, the majority of what drives the valuation of the company, is this Bitcoin treasury, and that's just basically we're going to issue preferred stock, debt, convertible notes, whatever they can, common stock, whatever they can do in order to sell stuff, bring in cash, and then sell financial products, I should say, right? Bring in cash and then buy Bitcoin with it. And the general metric, or the general rationale for them doing that, is they are trying to increase the amount of Bitcoin that they have on their balance sheet divided by the fully diluted share count that they have of common stock. And so that is, I actually have a model there, and a lot of how I would want to value MicroStrategy does come down to, what do you think is a fair multiple on the value of their Bitcoin? Because a lot of people call that MNAV, right? The multiple on the net asset value of the company. And some people would argue it should be 1. Some people argue for numbers that are way higher than 1. I went through some math to where I actually think 1.2 to 1.3 is a kind of fair value for the company. But yeah, if you're requesting, I can talk about MSTR again in my next live stream. They do have some new products since the last time that I did my live stream on MSTR, but a lot of the math hasn't changed because they're very similar to what they've already had. Anyways, any other questions or comments, or if you have, if you have more questions specifically on MicroStrategy right now, I'm happy to talk about it. I'm also happy to do that as in more detail in the next live stream. Or if anybody else has questions about NextDecade, I'm happy to talk about that, answer any questions or rumors you've heard. I really had no more prepared material. I will stick on for a little bit more if I have more questions or comments that come around. I know people do seem to be dropping off, so I'll give it just another minute, but I'm not going to waste everybody's time too much if I don't have anything to talk about. Again, thank you everybody who was here. I really appreciate having, I think at peak 10 people today. That was fantastic. I think 7 people are still here, so let me know, again, if you have any other questions or comments about anything I've talked about on the channel, or some future suggestion for a topic you're interested in, you'd like me to take a look at. I do follow the markets, even if I'm not active on my channel. I'm gonna try to stream, when I can. Again, my sweet spot, my sweet spot cadence for streaming would be about once per week. It's hard to find time to do more than that. Honestly, it's hard to find time to do it once per week. So Wakaza asks, what have you been up to? I have been, I think I mentioned at the beginning of the stream, I don't know if you were here. We adopted a toddler about 3 or 4 months ago, and it's been really busy, and he's takes up a lot of our time. Other than that, we actually have 4 kids, and so they take up most of my time. That's what I've been busy with, and especially when they're off for summer, they're around all the time, so there's just a lot. We went on vacation, visit family, so yeah, been very busy. Ray says thank you for the stream, by the way. Thank you for hopping on, Ray. And I guess thank you for sharing it. Matt said you shared it, so I really appreciate that. That's great. All right, I don't see anything else in the chat. Thank you for the congratulations. I don't see anything else in the chat now, so if there's nothing else in the next 10 seconds or so to bring up a new topic, I'm gonna hop off because I don't want to waste anybody's time. I really appreciate everybody watching as much as they do. So I'll give it just a little bit. Again, give my very last thanks for everybody tuning in. If somebody has a topic, I will talk about it. But again, I have nothing else prepared. I do think it's an interesting time in the markets. All right, I don't see anything, so I'm going to wrap it up. Thank you very much for watching. Appreciate it. Have a good day, everybody.